Are you confident you've taken all the right steps to optimise your super leading into retirement? The truth is, most people aren't. But don't worry, in this video we'll be going through 10 essential retirement planning strategies that our clients use every day. These strategies not only boost your super but also reduce your tax and give you greater confidence in your preparation for retirement. I'm Chris Strano, Managing Partner of Toro Wealth, where we specialise in providing retirement planning advice for 50 to 70-year-olds. I'm also the founder of superguy.com.au. If you're new here, make sure you click that subscribe button and hit the notifications bell so that you get notified each time I release a new video. As always, this video is general advice only and does not constitute personal financial advice, so please read the disclaimer below. During your final working years, the general objective should be to get as much into super as possible due to the favourable tax treatment on investment earnings and the tax-free income once you retire. So let's take a look at the 10 most common retirement planning strategies that will not only help you get more into super, but also reduce the tax you pay before and after retirement. Number 1, salary sacrifice. Salary sacrificing involves asking your employer to redirect a portion of your salary into your superannuation account rather than receiving it as personal income. So why would you salary sacrifice? Well, when you make salary sacrifice contributions into super, this portion of your wage is taxed at only 15% upon entering super, or 30% if you earn more than $250,000, rather than being taxed at up to 47% when received as a wage in your own name. There are, however, a few things to be aware of when salary sacrificing into super. Access to funds. Any amount salary sacrifice into superannuation cannot be accessed until you reach at least age 60. Reduced income. Salary sacrificing will reduce your net take-home pay. Therefore, you need to ensure you have enough money to cover everyday expenses. And the concessional contributions cap. Salary sacrifice contributions will count towards the concessional contribution cap of $30,000 per person per financial year. The number 2 retirement planning strategy is personal concessional contributions. Personal concessional contributions occur when you deposit a lump sum into your super account from your personal bank account, and then claim a tax deduction for the amount that you contributed. Both employees and self-employed individuals can make personal concessional contributions. The reason you would make personal concessional contributions is to receive a personal tax deduction for making the contribution, which simultaneously increases your super balance and reduces your personal income tax. Now, even though contributions tax of 15% will be payable, or 30% for higher income earners, the contributions tax rate should be lower than your personal tax rate. However, there are some things to be mindful of. Again, access to funds. The amount that you contribute to super cannot be accessed until you reach at least age 60. Deductible age limits. If you are aged between 67 and 75, you will need to satisfy the superannuation work test to be eligible to claim a tax deduction for personal super contributions. And the need to submit a notice to your super fund. You need to notify your super fund of your intention to claim a tax deduction for the intended amount and then receive confirmation from them prior to lodging your tax return or transferring any funds out of your super fund. Moving on, number 3 on the retirement planning strategies list is the most underutilized retirement planning strategy and certainly provides the most bang for buck. Number 3, unused concessional contributions. Carry forward unused concessional contributions refer to your ability to utilize any unused portion of your concessional contribution cap from the previous 5 years, provided that your super balance was below $500,000 on the 30th of June just prior to the current financial year. In theory, this could allow concessional contributions of more than $150,000 to be made into your account this financial year alone. Using unused concessional contributions can not only increase your super balance, but can also significantly reduce your personal income tax in any one year. Utilizing any unused amounts can be particularly useful in years when you have higher than usual taxable income or sell an investment with a large capital gain. But you should be mindful of how much to use, because unused concessional contributions can easily run into the tens of thousands, but it's not always best to use the full available amount. So you should speak with your financial advisor or accountant about the optimal amount based on your tax position for the year. Number 4 on the list is non-concessional contributions. Non-concessional contributions are after-tax contributions made into super from your personal bank account that you do not claim a personal tax deduction for. Non-concessional contributions allow you to invest more in the tax-effective superannuation environment ensuring tax on investment earnings is limited to a maximum of 15%, reducing to 0% in retirement. And the compounded benefits of these tax savings can give you more in retirement and have your retirement savings last longer. In fact, the benefits of super contributions is one of the steps in my 6-step super check, which you can download for free right now. See the link in the description below this video. Like any super contributions, remember that any amount you contribute to super as a non-concessional contribution will not be accessible until at least age 60. Also, be mindful of the annual non-concessional contribution cap of $120,000 per person per year, because exceeding this could result in excess contributions tax if you don't use the bring forward rule. Speaking of the bring forward rule, our number 5 retirement planning strategy is the bring forward rule. The bring forward rule allows you to bring forward the next 2 years of the non-concessional contribution cap and invest up to $360,000 into super over a 3 financial year period with no regard to the annual cap. The bring forward rule is triggered in the financial year that your non-concessional contributions exceed the annual cap of $120,000. Using the bring forward rule allows you to get more into super sooner, which can be particularly useful, for example, if you have a large lump sum to contribute resulting from the sale of investment property or the receipt of an inheritance, for example. Just make sure that you consider the timing of the contributions. The bring forward rule is triggered in the financial year that your non-concessional contributions exceed the general cap. And a key consideration is whether you should be triggering it in this year or in next year. Also, think about the amount you will contribute. Although the bring forward rule does allow you to contribute up to $360,000, you do not need to contribute this amount because a lesser amount might be more appropriate based on your circumstances. The next strategy on my list is my all-time favorite retirement planning strategy because of all the benefits that it can provide. Number 6 on the list is a transition to retirement pension. A transition to retirement pension is a retirement income stream that you can start with your superannuation accumulation balance even while you are still working. Affectionately known as the TTR pension, it allows you to receive tax-free income of between 4% and 10% of your balance each financial year. A TTR pension can provide you with a supplementary source of income that allows you to reduce your working hours in the lead up to retirement, or have more income to pay down debt faster, or reduce tax through a transition to retirement strategy, which in essence replaces a taxable wage through salary sacrifice with tax-free TTR pension income. However, before starting a TTR pension, you should be aware of the following considerations. Firstly, future contributions. You can't make contributions to a TTR pension account, so rather than using your total super balance to start a TTR pension, you might consider leaving a small balance in your accumulation account for the account to remain open so that future contributions can be made into it. Insurances. If you have existing insurances in your accumulation account, you should be mindful not to close your accumulation account if you would like to retain the insurances. Consider leaving just enough in the account to cover premiums until at least retirement. Reducing retirement funds. Accessing your super via a TTR pension prior to retirement without replacing it through contributions is likely to leave you with less super to fund your retirement. Alright, our number 7 retirement planning strategy is an account-based pension. The best invention since the drive-in movies. An account-based pension is a flexible retirement income stream that allows you to choose the level of income you would like to receive each year, subject to a minimum amount. You can also make ad hoc lump sum withdrawals at your discretion and choose how your balance is invested. Plus, all pension income and all investment earnings, including capital gains, are received completely tax-free. So when would you start an account-based pension? Well, once retired, an account-based pension can be your main source of retirement income and be used in conjunction with other sources of income, such as the age pension or investment income, to cover your retirement expenses. Tax-free income and earnings make an account-based pension a very tax-effective way of funding retirement. But a few things to keep in mind. Firstly, longevity risk. An account-based pension is not guaranteed to provide you with an income for the remainder of your life. The longevity of an account-based pension is determined by your level of drawdown and the investment earnings within the account. And once the account balance reaches $0, no further pension payments will be received. Also, consider investment options. Now that you'll be drawing down on your retirement savings, you need to review how your superannuation is invested, because you're effectively going from buying investments at regular intervals through contributions to selling investments at regular intervals via pension payments. So usually a more conservative portfolio can provide greater certainty in retirement and less overall impact in weak economic environments. Another consideration is income drawdowns. Ideally, you should only withdraw from a pension account as much as required to cover expenses and no more, leaving as much as possible in tax-free pension phase. Okay, the number 8 retirement planning strategy is a recontribution strategy. A recontribution strategy is the process of making withdrawals from your superannuation account and immediately contributing them back into super as a non-concessional contribution with the intention of magically converting taxable components into tax-free components. This can reduce or even eliminate taxes on death. This can be done by lump sum withdrawals, if you're eligible, or through account-based pension payments or TTR pension payments being recontributed. Importantly, all withdrawals must be made proportionately from each component. The benefit of a recontribution strategy is that if your super balance includes taxable components, which it likely does, and if it's likely that your super will eventually be paid to a non-tax dependent, like an adult child, when you pass away, then a recontribution strategy can reduce or eliminate the death taxes that will be payable. Now, this is a more advanced strategy, so you probably should get advice around this to ensure that it's implemented correctly. Also, you do need to be aware of the following: contribution caps. Because by withdrawing super and recontributing, you are using up contribution caps for money that was already in super. And this could restrict your ability to get more money into super at a later date. Withdrawal taxes. Generally, withdrawals from super from age 60 onwards are tax-free. However, if your super balance includes any untaxed components, taxes may be payable. Sale of investments. You should be mindful of any investments within super that need to be sold to complete a withdrawal and recontribution strategy and the associated transaction costs. Capital gains tax. If investments do need to be sold to complete a recontribution strategy, you should be aware of potential capital gains tax implications resulting from the sale. Alright, before we get to arguably the best retirement planning strategy, let's take a look at number 9 on our list, which is a spouse contribution tax offset. A spouse contribution can provide you with a personal tax offset of up to $540 per year if you make a contribution of up to $3,000 to your spouse's super account and your spouse has an income below $40,000. The tax offset amount is calculated as 18% of the lesser of $3,000 minus the amount by which your spouse's income exceeds $37,000 and the sum of your spouse contribution for the year. To be eligible for the spouse contribution, the contribution needs to be made directly into your spouse's super account. You need to notify your super fund that it was a spouse contribution, and you need to record on your personal tax return that you made a spouse contribution. The resulting tax offset of up to $540 each year is an effective return of 18% on your $3,000 contribution amount. Just remember though, a spouse contribution counts towards your spouse's non-concessional contribution cap. It's not a deductible contribution. It must be made into your spouse's account, not yours. And your spouse needs to have a total super balance below $1.9 million and be under age 75. All right, last but certainly not least, our number 10 retirement planning strategy is the downsizer contribution. A downsizer contribution is a contribution made into super with the proceeds from the sale of your home. And you can contribute to up to $300,000 per person as a one-off contribution to super without the contribution counting towards any other contribution caps. To be eligible to make the contribution, you need to be at least age 55. There is no upper age limit. You need to have owned your home for at least 10 years, and it needs to have been at least partially exempt from CGT under the main residence exemption. Plus, the contribution needs to be made within 90 days of receiving the home sale proceeds. A downsizer contribution allows you to invest more of your wealth into the tax-effective superannuation environment. You can only make one downsizer contribution in your life, so make it a good one. Using one or more of these retirement planning strategies is likely to improve your financial position as you approach retirement, giving you the ability to retire sooner or with more. However, for these strategies to be effective, they need to be relevant to your situation and implemented correctly and with certainty. If you need help with your retirement plans, our financial planning firm Toro Wealth helps 50 to 70-year-olds optimize their financial position in the lead up to retirement and feel confident about retirement. Go to torowealth.com.au to find out more. If this video was helpful, remember to click the thumbs up button to show that you liked it and the subscribe button for more content.